All right, guys, welcome back after Thanksgiving. I hope all is well with family, life, and business. Today, we got to get back on the grind, start making some money, but that's a big part about the real estate business. You have to have money to make money. So who's got your money? Where's your money at? Today, we have a guest that can help you get that money because this business of real estate is capital intensive. If you don't have money, you can't buy houses. So let me introduce you to my guest, Scott Brown. How you doing, Scott?
Connor. Hey, man, I'm excited to be with you.
Yeah, I'm glad to have you on the show. And let's go ahead and give you a second to kind of introduce yourself and kind of, the name of your company and what y'all are doing. And then we'll kind of dig in a little bit more in detail about the opportunities that our listeners and our audience have to work with you.
Excellent. Well, thanks, Connor. So USAPrivateMoney.com is the way you can find us. And we work nationally as on some deals, we broker. Other deals, we do private money. Other deals, we do correspondent lending. So what we did is we came up a way to have a national solution to help people fund their deals, their non-owner occupied real estate investment deals.
Okay, guys. So getting in this business, you realize one of the biggest issues besides from finding deals is finding the money to do these deals. So they provide fix and flip loans. They've got an interesting service that they can do JV deals on properties under 50 grand. They also do long-term rental loans. So we're going to kind of touch on these. And I think their most popular product that most investors come to them for is their fix and flip loans. So let's kind of go through the hard money loan process and kind of what it looks like for someone to reach out and work with you. So if someone was to, get a house under contract and they come to you, what does that kind of look like? What was the process? And I know y'all want to have them pre-approved. So let's go through the best way an investor can kind of prepare themselves to be able to successfully get a loan.
Right. And so I'd say this is probably the biggest misconception in real estate investing that we see over and over again is somebody's gone to a course or they've invested a lot of money and in one of these, no money down type opportunities, which absolutely, I've done a lot of deals, no money down, but I'm going to tell you, you work hard to do those no money down deals. But the biggest question that we get all the time is that, how fast can I close? Why can't we close this in 2 or 3 days? And so what I'm going to say to people is that there's fast money and there's smart money. Fast money is your typical hard money, lending deals. You can close those in a day to 3 days, and you're typically the cost of that money is anywhere, depending on state, it could be as low as 11 in California, and it could be as high as 15 to 18 in some other markets, and it's anywhere from 3 to 4 points. Now that's fast money, right? But here's the deal with that. The fast money, what you end up getting with that is you got to typically put 30% down and you got to come in with all the rehab. So that's a tough loan for the average real estate investor, to pull off, right? And so then there's smart money, and smart money is the money that we take you through a pre-approval process. Think of it kind of the days of when the subprime lending was out there. So subprime lending, you would go and try to get approved for a conventional loan, and they said, no, you don't qualify. But then you could go to what they called a B and C lender, and a B and C lender would say, can you fog a mirror? Then you can get pre-approved, right? You remember those days?
Yep. There's
all right.
Yep.
So that is what we call smart money in our business. So smart money is we take you through a pre-approval process and we collect the same kind of documents that you would have collected if you were doing a subprime B and C loan, a decade ago. And so what does that look like? Well, there's 32 documents that we collect and you're like, whoa. And so here's what you got to decide. Do you want 80% to 90% of the purchase price? And do you want up to 100% of the rehab? And if you do, then you need to get pre-approved and you need to go through that process. Now, here's the cool thing. Once you do it once and we take you through that pre-approval process, we have the majority of your documents. So what we look for, three sets of documents. Borrower documents, that's your, taxes and, driver's license, that kind of thing. And then those are borrower documents. Then you got entity documents. And the way that we're able to do this across the nation, the way we do is entity to entity, business purpose. And if we do it that way, it bypasses a lot of the lending laws that are heavily scrutinized. And so that entity allows you to kind of go into that fast lane and get some treatment from a company like ours that can handle it nationally. And the third thing is, so there's the property documents. So you won't have those property documents until you get that property under contract. But here's what typically happens. Somebody gets a property under contract, and then they call us and say, hey, I need to get this deal funded. And what they do is they shoot themselves in the foot because they don't realize that if they would go through the pre-approval process with us, it's like walking around with a blank check in their back pocket. Then they go find the property. Does that help you kind of get the feel for the two loan types there?
Yeah, so most people are just, by nature, they procrastinate, right? A lot of them, they don't know when their deal flow is coming in, so they're not prepared, and all of a sudden just randomly gets a deal and it's headed to foreclosure. And so, they have to act quickly, which is what the benefit of that quick loan on the front side. But guys, go ahead and get your applications in. So like what all are you looking for when it comes to the front side as far as income, credit score, like so people can kind of have an idea? Because a lot of people, tend to want to raise private money from private individuals because they don't have that qualification, or they don't think they can qualify, or they don't want to work on their credit. But if they're close on their credit, they can get it up a little bit. Or how do you look at it as far as what someone you're going to pass as far as the application process?
Yeah, excellent. And so that's the good news here is now when we talk about fast money, which is that hard money space, and then there's we call it soft money or private money in that sector. What's awesome about that is if you have a low credit score, or you have limited experience, or you have a rural property, or you have, typical things that would disqualify the average deal, we have a whole litany of lenders that we work with, all the way from private money lenders, mom and pops who have idle or anxious money sitting on the sideline that they want to put to work, yep, to institutional funds that we work with. And so we basically, in that pre-approval process, figure out where you fit in the matrix. And based on where you fit, then we are able to issue a term sheet and a pre-approval letter to you so that you can then get out there and do what you need to do. In other words, if you've got a 500 credit score, for whatever reason, you may be feeling like you can't get funding. And I'm telling you, that's absolutely not the case. It's more deal specific than it is credit specific. So there's things like that. So we have 26 different questions we take people through, and we really understand where they are and make sure that when we take you through that pre-approval, so our deal intake, we ask all the tough questions so that we know exactly what we can do for you.
Okay, so is it kind of like a guidance line or credit line, or are you looking at each property as they come in? So say someone so they went through the approval process, then they find a deal, they submit it to you through your website, or how does the next step happen for these individuals who want to work with you?
Right. So what we do is there's three sections in our company. So we assign you what we call a PMC, which is a private money consultant. And the private money consultant is there to really answer all your questions up front, make you comfortable with the process, and talk to you about, hey, based on your scenario, here's what we can offer you. So they're assigned a private money consultant. Once the private money consultant, we do two things differently in that process that most of the lenders you're going to call, especially if you've got first-time flippers. I'm going to tell you, no one shines as well as we do with first-time people. We have this wired. In fact, some of the nation's largest coaching and education companies use us exclusively for their first-time students because we perfected a process to get them funded. So that being said, what we do to make sure that we have a client, it's a little different, is we have a consulting agreement, we have you approved. Now, this consulting agreement basically spells out what we will do for you and what we won't do for you. And when I say what we won't do for you is essentially we take you through this pre-approval process, but at the end of the day, only you can go out and find a property. We can't go find the property for you, right? You got to go do that part. but we will do everything on the funding part. But we spell it out so there's no confusion or anything. The other thing we do is we take a flat fee of $1,000. Now, in the industry, most people say to you, don't pay upfront fees. That's a scam. Well, I'm going to tell you that if you take advice from the wrong person, it will absolutely kill your business. And so what we learned is you would much rather pay us $1,000 to help you get funding on a deal than to take a deal in from you and then charge you $3,000 to $5,000 in broker fees. So what we're trying to do is leave the meat on the bone for you, but we've got overhead. So we've got the private money consultant, and then what happens is your file goes. Once we collect the $1,000 consulting fee and we take in the consulting fee agreement, then it goes to a transaction coordinator. Now, look at a transaction coordinator like you would a processor. Our transaction coordinator works with you, and they're assigned to you to help you collect all the documents, help you get everything input the right way. And the way I like to explain this is that we can all relate to if you look at packaging up a deal, one package is just a box that's messy with a bunch of papers in it. Another box is all structured, packaged nicely with a nice little bow on it. And you walk to present that to the lender, and the lender sees that we've crossed all of our T's and dotted all of our I's, and there's a systematic approach to it. They're going to approve the loan.
Yep.
And so that's what the transaction coordinator does to get that all put together. Now, we do all of that before there's a property, meaning we collect all the borrower docs, we collect all the entity docs, and we collect, obviously you don't have a property yet, but the moment you get a property, then it goes to, in our office, a closing coordinator. Now, that closing coordinator, we kind of joke about when a file has its own personality. It's kind of like a baby being born. If you've had an opportunity to see that experience, we have 3 daughters, and when it's time for the baby to be born, it's like all hands are on deck. Everybody comes in and everybody helps out, and so that's the process. It's like all hands on deck. When you have a deal that needs to get closed, we have a closing coordinator that stays there, works with you, and gets that deal all the way through. Now, I'm giving you a lot of detail, but I think detail is important, that people understand that we have a process.
Yeah, I think it's a really good, efficient model. Okay, so let's look at kind of a case study here. So the reason why most people can't scale is because they have to leave too much in each deal, right? So on a typical deal, they have to bring points up front. They have to leave money in escrow or for draws later. Let's take a $100,000 property, a traditional flip. And you're saying you can do, if they get pre-approved, you can do a higher loan. So like, what is their total cost? They come to you, let's say you're doing a $100,000 loan. They're going to have upfront fees, upfront costs. How much are they going to have to leave in the deal? Like, kind of what do the numbers look like?
Yeah. So first thing is, on our website, we have a deal analyzer calculator. And I'll give you a shortcut to the web, to the calculator. But if they go to usaprivatemoney.com/FF for fix and flip, FF, when they get to that calculator, they're able to put in the details of the deal. So basically what we need is 3 things. We need to know your buy price, we need to know your rehab amount, and we need to know your after repair value. And you put in those 3 numbers, and then off to the right, if you look at box 20, and if we need to at another time, we could have another session where we go through that calculator and analyze some deals and just really help people get their head around what this process looks like. Yep. But once they put those numbers in, it tells you real quickly. And it's the same calculator that we use. And if you say, well, how did you come up with it's simple when you see it. And what I'm going to tell you, it's hard work to make things simple in a business. Well, we simplified that process by creating that calculator so you can your students or clients can look at that quickly and see if it's a fundable deal, meaning what is the estimated down payment? Do you have that money? And what is the projected profit? Those are two critical numbers when you're doing a deal, and that will tell you that in less than a minute. And so what I'll tell you is you asked a really good question, so I want to give you a little more detail. So somebody that has never done a deal before, here is what they should expect. And you're going to say, well, maybe they can't afford to do a deal then. Remember, we do JV funding, right? So if they don't have the capital they need, then we'll consider doing a JV funding with them and helping them get that deal funded. So, for example, if it's a first-time deal all across the nation, I'm going to tell you things are a little different if you're talking about Boston, if you're talking about California or like Washington State. Things are a little different than, say, in Indiana or Ohio. So just keep that in mind when I give you a general answer. It's for the states that, you said $100,000 loan. So here we go. The average $100,000 loan, what you're going to see is 80% of the purchase price the lender's going to fund. They're going to want you to come in with 20% out of pocket. Now, here's the cool thing. They don't care where you get it from. It could be mattress money, friends, families. It could be gap funds. It could be credit cards. It could be, there's different websites that we can refer people to that can help them get that capital. So they don't care where that 20% comes from. Now, the other question is how about how much of rehab? The rehab portion, I'm going to tell you on a first-time flipper, just to keep it super simple, 20% of total cost. So if they're buying a house for 80 and it has 20K of rehab, that's 100,000. They need 20K of down payment money to do the deal.
Yep.
Does that make sense?
Yep.
Plus the hard cost.
Yep.
So, and that deal, I don't care if you got a 500 credit score or an 800 credit score. The only thing that's going to be different for that person is the interest rate and maybe an extra point if they have a 500 score. And that's not us setting it. That's institutional money setting that pricing.
Okay. So now what about the other processes that you're going to have to go through? So, y'all are doing this nationally. Every market's a little different. You got to have some way to validate these numbers. You can't just trust the comps that some random investor sends in, right? So are y'all requiring appraisals, inspections, or what else goes along with it? Like to make sure that, because y'all aren't just going to fund some random deal on some investors' numbers that they shot across the country to you. So how does that work? How do you guarantee the value, or how do you, on your side, to protect yourself? Plus, protecting the borrower, because a lot of these new investors, they don't know what they don't know, and they can get themselves in trouble really quick.
That's right. Well, those are excellent questions, Connor. So the first thing I'd tell you, if it's a hard money deal, and let's just say it's somebody needs to close in a day or two, typically that does not require an appraisal. Typically, that is a BPO, or it's just a hard money lender or private money lender we work with that does the hard money type fundings. They'll run their own comps, and when they're at 70%, maybe 65 of acquisition, and you got to come in with the rehab, that's a pretty safe loan, so they don't need the appraisal. The moment that we shift gears and we go to what we call smart money. So that was hard money or private money. So we go to smart money. Smart money is you go through the pre-approval process. That process requires an appraisal almost every time. And so that appraisal is ordered by the lender. And when it's ordered by the lender, typically what that looks like for the borrower is there's an application that we go through, help you fill out, submit your file. Once they accept your file and it looks like a doable deal, then they obviously have to check value and they need the title report. So they will order from a third-party appraisal service like Appraisal Nation an appraisal, and that value will come in. But I'll tell you, one of the things we do on our end is we double check that, especially if someone is a new investor. We don't just take their word at the value. They say, oh, we think this value is here, because we don't want you paying for an appraisal, right? And then you're being upset.
Yep. So
what we'll do is here's a simple way to fix that. Get two comparable reports from two different real estate agents, because you got to sell the home after you fix it.
Yep.
You're going to interview these agents and ask them, Hey, what do you think the value is of this house after it's repaired? And here's my knockout punch question to that agent. Hey, all right, you said the value is 150. If I want to sell this home in 30 days, what is the value? And they'll come back and say, well, shoot, if you want to sell in 30 days, the value is 120. That is really your value.
Yep.
And too often we get misled, not intentionally, but the agent is trying to give you what the top side is. As an investor, you got to look at what the bottom side is to make sure that you can get in and out of that deal.
Yep. Okay. The last thing before we move on to the next topic is the inspection side of things, right? So money's not cheap, right? If you're doing a decent sized rehab, say you borrowed 300 grand, your carrying costs can be quite a bit. And so how does your inspection process and the draw release process work? Because some of these lenders I hear people complaining about, they may take 7+ days to get them their next draw. So speed of implementation on that side of things can really help these investors if they're paying $100, $200 a day in carrying costs. So how does the draw request and process work with your company?
Right. So remember, we straddle this. There's different levels. So there's hard money, there's institutional money, and there's private money that we all work with. And basically, we look at the deal, we figure out what deal, what kind of money is going to best fit this deal. And so if we talk about hard money, for example, typically hard money, you don't have to worry about the draw process because you're coming in with all the money out of pocket anyway. So that you can check that box, right? That was the deal where you had to put 30% down and you had to do all the rehab. So you don't have to worry about draw money there. Second is institutional money. Institutional money, I'm just going to tell you, it's not a fun process, and you nailed it. You nailed it when you said there's these lags and all this different stuff. Yep. It's absolutely the case, yep. Right? And so that's why a lot of people go to private money to eliminate all this. They can cut out all this red tape and things that they don't like, and ultimately, I think that's a good spot for someone to be in, and rightfully so. That's what we do. We think being a lender is a sweet spot to be in, and so we work with private money investors ourselves, and we're able to then go in and capture these rates for return and do a revenue share back with these lenders. So if you're doing the smart money, you're not going to avoid these lag times. Typically, what ends up happening is you're going to have to go through that whole process, submit the draw request. But what we try to do on our closing coordination side is we try to stay in front of that with you, and we're constantly prodding you to say, hey, you need that next draw, and the closing coordinator that's working on your deal is going to say, hey, go ahead and start getting this into us so that we can make sure that we can get that draw released to you.
Yep.
But it is a messy piece of the deal.
Yep. Okay, guys. So, you had something else that you want to add in there?
I was just going to say private money, we can shorten that up a lot because we control the cash.
Okay, great, right? Great.
Whereas institutional, we have checklists, but we're not as rigid as some of this institutional money that's out there.
Okay, great. So let's go ahead and transition to this other product that you have, which I think is interesting because, this is a real service needed for a lot of investors on these lower price point properties. The banks won't finance them. They may not know private money lenders that can come in and help them out. So these properties are under, say, 50 grand, right? Y'all do a unique thing with these properties that with people that you work with. You can do a JV split with it, or how does that kind of work?
Yeah. So we kind of fell into this by accident. And so one of the things that I didn't tell you that was my background is that the way I got started in this whole private money game is that I wholesaled over 3,000 low priced homes.
Wow.
And
that's good.
Yeah. And it was, most of it went to one client that was it's not like I was, a lot of your students and people that are going to see this, they're doing one-off deals. I managed to get a big client that wanted a lot of inventory, and I went out and found that inventory and was able to wholesale all those homes. But as they move those homes down the funnel, what would happen is people would frequently say, where do we find private funds? How do we fund these deals? You can't get a lender to fund a $50,000 loan. It's just over and over and over is the message that would come up.
Yep.
And so we started down that process of helping people identify funds for these kinds of deals. And what we learned along the way is that if you charge 10 or 15% interest and 2 or 3 points, there's no money in that, and that's why none of the lenders do it. And also, if they charge higher interest rates and take higher points, they're seen as predatory lenders, and they don't want to be categorized that way, right?
Yeah.
So we figured out, and also, I'm a investor myself. I buy the exact same houses, these 50K, sub 50K homes. I buy those homes myself. In the last 90 days, I think I've probably purchased, I don't know, my wife could tell us better, but 25 houses. Wow. And I do the seller finance model on those. And then, we take it through the process. We identify a tenant buyer, and we create a mortgage and a note, and then we sell off the note. I call it flipping paper. Yep. And so there is a huge, huge need there. And what we discovered is that we could, the same capital, we could bring it to the forefront and make it available to these investors, but we would do it in a JV manner, because I'm pretty familiar with these lower priced homes. I know the things to look for because I've done a lot of this. And so this is our own little niche internally. And so we basically split the profits with somebody that wants to get in and flip a home that they can't get somebody to fund. And our only caveat on this deal is we will fund the buy 100%. We'll fund the rehab 100%. The only thing that we want the investor in the deal to do is to have the money for that first draw. We want to make sure that they don't do a hit and run on us, get the capital, and then don't work on the property, right?
Yep.
So we want them to have the money for the first draw. And as long as they have the money for the first draw, they complete that, we will then reimburse them. And so by the time there's 3 or 4 draws done, they've received 100% of the funding on the deal. And then when that deal sells, we split it with them. Typically, we split it 50-50 with them. Most of these deals have 20 to 30,000 profit. Sometimes we see deals with 40,000. But does that answer your question on what we do and how we do it?
Yeah, I think it's good. So is there a limitation on what type of exit strategy that you'll do this with? Will you do a JV split where y'all just keep your money in and let them rent it? Or are you just doing the owner finance note flip model, or are you doing, because some of these people can come in and prehab, or what if they just want to close on, they don't have the money, say they don't have a buyer's list, they want to close on it, say it's worth 25, they know it'll sell for 50, they want to close on it and throw it on the MLS and kind of, wholesale it through the MLS. So like, what limitations are there as far as a strategy that you're willing to partner with them on?
Yeah, I'm open to all of those kind of strategies that just make sense.
Yep.
Most of what we've done has basically been, it was an answer to, remember, we have all these major coaching companies sending us their students, and they have people in Indiana or Ohio or Mississippi, and they have a deal. Yep. And they bought the thing. They got a great buy on it for 10 or 15, 20 grand. And they're like, look, we only need 20K in this thing and it'll sell for double. Yep. And I think that's a hidden market, a really hidden market, because there's not, the banks aren't lending. And so what it does is it offers the banks end up, when they have these REOs, they sell them at a deep discount just to get them off the books. And so, yeah, I like this niche, and I'm open to any of those types of discussions. As long as somebody wants to do a revenue share or split on it.
Yep. So the new thing here, a lot of people are doing is they're buying mobile homes on land. Will you do these types of transactions? Are you staying strictly with single family? Will you mess around with condos or townhomes, or is it just single family? That's it.
I'll look at it all. In fact, I've done them all. I've got some of my best deals have been mobile homes.
Yep.
I bought a mobile home for 11 grand on an acre in Cowpen, South Carolina. And we sold that thing for, I don't know, I think it was 63,000 seller financing. That was a sweet deal. Good for them, good for us. Everybody made out.
Yep. Okay, so like on the owner financing strategy, how much do you need your original catalyst, the part like the individual bringing the deal? How much do you need them to do? You need them to find the tenant buyer, find the note buyer, or you just need them to find the tenant buyer, and then you have a database of note buyers on the back end that you're going to help with that side of the process? Because I think that's where a lot of people get worried with this, buy and create a note. What happens if they can't sell a note and they have to pay off an underlying lender? That's the big fear I see from a lot of people. So do y'all have the ability to assist them in selling these notes on the back end?
Yeah, we'll absolutely. So let's look at it as that is our worst exit, meaning if we typically what we like to do is somebody that's wanting to come to us and flip a house, right? But I'm super comfortable with this space because if they get stuck in a deal, meaning they thought that they were going to flip the home and nobody bought the home. Well, I'm super confident in my ability for us to then put a tenant buyer with a note and a mortgage in the deal, and then we work on an exit to sell the paper. Yep. It's a great model.
That's pretty much how most people become an owner finance investor for the most part, is they flip a house sometimes and then they're like, I don't know what I'm going to do. I can't sell it. And then, so that's kind of what happened to me on one of my first ones. I literally flipped a house in a small market, 3,000 people. And I just got to this, investors start making money, they start doing deals and they start feeling invincible. So they start taking down everything. And I got onto this house. It was supposed to sell for 120 all day long, and I couldn't sell it. I couldn't even sell it for 85, and I didn't know what I was going to do. And so I owner financed it and seasoned it for like 6 months and sold that note. So it's a great strategy. And it's just there's a lot of unknowns for investors. Maybe we'll have you back on here and do a different podcast talking about kind of more in depth of the strategy we're talking about. But let's go ahead and talk about your Private Money 360. We touched on this a little bit earlier when we talked before the podcast. I think this is interesting. And let's talk about that here real quick.
Yeah. So what happened with Private Money 360 is that, we speak at various places and that have these new investors that are getting educated, and we all have to start somewhere. And so in the room, what we find all the time is that there's always, I call them a sleeper. There's somebody in that room that's got a wad of cash. And I call it idle or anxious money that's sitting on the sidelines. They don't know what to do with that money. And they're trying to figure out where they put it to make it grow, but that they don't take a big risk of losing. And so one of the questions we ask people all the time that have their money in the market is, I ask them, how much of that money are you willing to lose? And what do you think the number one reply to that answer is? How much are you willing to lose?
Probably say I don't want to lose anything.
That's exactly right. And I say to them, well, why do you have it somewhere where you can lose it? It makes no sense to me. And they're like, well, there's no options. The bank is horrible. So what options? And so we say, Private Money 360 is the answer to that. And what we did is we took our years of experience. Since 1998, I've been doing deals. We've done over 4,000 deals. If you add in those 3,000 wholesale deals and 1,000 loans we've done. And what we've done is we've packaged that all up. Our systems, our processes, our checklist, the cardinal rules that you don't do, the things you do. And as best as I can tell, Connor, I've spent about $16,000 in legal fees in the stuff that's in the kit, right? Yep. And so what I do is we offer Private Money 360 as a bonus to anybody who has idle or anxious money sitting on the sideline, for us to really coach and mentor them on how to be the bank. And it works well for them because we give them the confidence that their money is safe, it's protected, it's collateralized with a real, a hard asset. And it gives them the confidence back in us to simply say that, wow, you guys know what you're doing. And so it works well for both sides. So if we've got any of your listeners that are sitting on idle or anxious money that they want to deploy and be the bank on, we'll offer them this kit and we'll take them through this training process and help them really get comfortable with being the bank. And once they get comfortable, it's tough to invest in anything else because these rates of returns are
Yeah.
phenomenal.
I mean, it always blows my mind how there can be so many successful people in business and out there in different areas where they made their wealth, but they just don't know what to do with it. It's like they made it so fast and they weren't really ever classically trained on where to invest it. All sorts of businesses take off. So what about people that have their money in a retirement account, like an IRA or 401k? Are you able to help educate these people and explain to them how to self-direct this, and then you can help them through the process? And so it's a win-win for both y'all?
Well, for sure. I mean, there's some simple things, and I don't want to. I've got to give a disclaimer here because we're not CPAs, we're not attorneys. We're just real estate investors that have figured out a niche here that's underserved, that pays a great rate of return. But absolutely, there's a handful of custodians that have a appetite or a tolerance kind of deals, and we'll work with them and help them. And so what we do is we just refer them to the appropriate source. But when it comes to deal flow, that's us, because we have deals that come in every week that we're looking, to fund. And so to speak to that, you talk about, people that have been, work professionally. We were just at an event about a month ago, and this husband and wife came up to us, and they were doctors, medical doctors. And I was stunned to talk to them, and they had paid, a lot of money to be at this event that we were at. And I was stunned that they were there. And I asked them, I said, you guys have awesome careers. Why are you here? And they said, well, we made our money. We now need to figure out how to manage our money throughout the rest of our life. And so they were there paying to learn this. And I'm telling you, this kit that we've developed it gives you all that detail, and we're continually enhancing it. But absolutely, we'd more than welcome the opportunity to give that kit away to people who have this capital that they want to work with. And here's what we learned. If you say, well, why are you giving it away? Is because a lot of the times what people will say to us is that, why don't you just put the money to work? And that's music to our ears.
I mean, I like what you're doing. I think it's great. Y'all plugged all the leaks. Y'all have a 360-degree business, right? So people who find deal generators, lead generators can come to you. You can fund their deals. And then on the flip side, people who have done well in life and made a bunch of money, then come to you as well, and you can help connect them on the other side. So it's a great business that you built. The last thing, let's go over, and so y'all do also have long-term rental loans, right? That you can help investors as well, right? So let's touch on this.
Correct.
So like, what are like the typical rates that y'all are doing for people, and kind of origination and kind of cost to do this type of loan for them?
Yeah. So here's what I would say to people. First and foremost, if you can go to your local bank and get approved, go to your bank and get approved as many times as you can get approved. Once the bank says they don't want any more of your business, we are a fantastic solution to you. So if you're going to try to compare us to bank funding, that's not the way you want to do this. Banks typically will only let you do 4 to 10 deals depending on the type of bank or their lending guidelines. With us, it's unlimited. You could do 100 of these rentals. If you love rentals and you're trying to figure out how to scale your business, our sources don't care how many you have, and they want the business. And so the way they're going to treat you is they basically want 20 to 25% down. As long as you have that capital down, or you've done a seller financing on a deal and you want to refinance out the seller finance person in the deal with you, you just need to be on title 12 months, and they'll season that loan. And so that's a no money down deal for you. So as far as interest rates, we find the rates are typically between 6 to 8%. They'll do a 30-year amortization on those, and you can pick if you want a 7-year fixed or if you want a 10-year fixed. You can pick, and they also have a 30-year fixed. So it's up to you what kind of what your exit plan is with your portfolio. But just know, to recap, you're somewhere between 20 to 25% down. Credit score, the higher the score you have with this, the better you are. Can we get your deals done? Yeah, 620. And if you've got a score lower than that, you really ought to look at getting that fixed, because these lenders they will flat out give you the access to the capital. And so that 20 to 25% down, 620 credit score, rate is between 6 to 8 points, typically 1 to 2 points, depending on your experience and your portfolio that they're going to get to work with.
Yeah, and so even though it's a little bit more than what the banks are going to charge, the value of having the ability to reach out to y'all and just get as many loans as you want, which is what happens to most investors. They panic. They're like, I don't know where to go. They've cut me off. That's a huge plus for an investor right there. So let's look at the refi. So is there a different seasoning period required? So what happens? So if they bought the property with a lender and have an underlying lien on there, compared to if they just pay cash out of pocket, can you refinance instantly if they do a cash sit or if they use their own cash, or do you still have to wait for the refi, the seasoning period to refi?
Excellent questions. I can tell you know your business. So those are any cash that you personally have in it. The way they're going to treat that is they're going to want you to leave 20% of your own cash in the deal, and they'll give you the rest of it back. So if you got a screaming deal that is worth 200, you got it for 100, and you paid cash so that you can move fast, what they're going to do is they're going to require you to have 20K of your own money in. They're going to give you a refinance of that 80K back out. But once that deal seasons for 12 months, you could do a cash out refi up to 80% of the appraised value, maybe 75.
Okay. And as far as the time to qualify, let's look at someone's who's going to come to you multiple times. What would be the initial qualification time period? Is it 30 days? Is it longer?
Yeah.
And then after that first loan's done, you have all their documents, you have their information. Does it speed up going forward? Does it accelerate the process down to a week, or kind of what is the time frame they're looking at to get one of these loans done?
I would tell you the best timeline that you're going to get to is probably 2 weeks. And the reason is that really it's because of ordering an appraisal. Yep. Have I seen them faster? Yeah, but I wouldn't want to set that as the expectation. I'd tell people to set the expectation for 30 days, be happy that it's 2 weeks. If it rolls into the third week, so be it. But, and you touched on one other thing here that I think is noteworthy that we bring up to your investors that are listening in. Frequently what will happen is, people will see a smoking deal and they'll pay cash for a property. And when they pay cash for the property, all their money's tied up in the deal. And we call that, if it's a fix and flip, we call that a rehab refi. And we can get those done in 2 to 3 weeks for people so that you can get all your money back and you can do it again, but you didn't have to wait for the lender.
Yep. 2 to 3 weeks that's really good, right? Most people are waiting longer than that anyway. So I think that's a good time frame. I guess do y'all have, people ask me all the time for credit line sources. Is this something y'all do? Do y'all do guidance lines or credit lines or anything like that? Or y'all just strictly doing individual loans attached to specific properties? Okay, guys, we lost him there for a second, but he's back. And we're going to talk about credit lines here because a lot of people are needing more money to fund their deals. And there's a difference between having a credit line to fund them as compared to putting an individual loan on individual properties. So do y'all have this option for investors out there?
That's a fantastic question. And the quick answer is yes. So if you go on our webpage this is something that's kind of new and coming into the industry, kind of fast and furious, is these lines and what it is and what it's not. And so if we could take a couple minutes and explain that, I think it'll help your subscriber base enormously. So if you look on our webpage on the top header, we have 5 testimonials of people that we got credit lines anywhere from, call it $700K to, I think one lady got a $6 million credit line with us. Pretty substantial. Now, so what does that look like, and what is it versus what is it not? And the biggest misconception about a credit line that people have is that they think if we get them approved for a credit line, they have blank checks that they can just go spend, right?
Yep.
All right. So that's not what this is. That's more like you getting a home equity line of credit. This is not a the same kind of line of credit. So I'm gonna simplify it. What it is let's say that you had $100,000 liquid. Well, what the lenders do is they'll give you 5 times that 100,000 if you're if you know if you've done at least 3 to 5 flips or you've done 3 to 5 rental properties, they will give you 5 times what cash you have. Now, if you back into this, really all they're doing is they're saying you have the ability to put 20% down on $500,000 worth of loans. Does that make sense?
Yep.
All right. Now it gets better. So I'm always surprised that there's people that have done, the most unsuspecting people that you meet, and they've done 100 deals or something crazy, and you're like, whoa. Well, for a person like that, let's just not even 100. Let's say somebody that's done, say, 10 deals in your subscriber base. They need to know that instead of it being 5 times the 100K, they're going to give them 10 times the 100K. So, and they're going to give them 100% of the rehab cost.
Wow.
So that is a smoking deal. And the interest rate on that line of credit is typically between 8 to 10%, and the points are typically 1 to 2. And so the way that all works is, for example, somebody gets $1 million line of credit. That means they could have $1 million in loans out with that lender. And if they qualify for the top tier, that means they're only coming out of pocket 10%. So let's make it real. So you're buying a house for 80, it needs 20K in rehab. So the total cost of the deal is 100K. So on that second example, what would happen is somebody would come in with $10,000 out of pocket, some miscellaneous closing cost here, maybe another couple grand in closing costs to get the whole deal done. Well, so they're out of pocket $12K on a $100,000 deal. And here's the beautiful thing about it. They could have 10 of those going at the same time with that line of credit. And they're underwritten as a borrower to start with. And then so the first deal takes about 30 days. Every subsequent deal after that, it takes literally, 7 to 10 days tops for that lender to take that deal in and take it all the way through. And so we're doing lines of credit, and the way we charge for that is different than the way the industry will say, yeah, we'll charge you 10 grand for a line of credit. And we're like, you know what? We feel like that's kind of killing the sheep. We want to shear the sheep, come back, right?
It makes sense.
The way we do it, is we charge you $1,000 to go through our pre-approval process. And then once we issue the term sheet that says, okay, your interest rate's going to be 9%, and the lender's going to charge you 1.5, and they're going to give you $1 million line of credit. Once we issue that, we collect another $1,000. And then when you fund your first deal with us, we pick up $3,000 on that first deal. And then after that, any deal that you do going forward, we have a deal worked out with institutional lenders where they split whatever they charge you. So if they charge you 2 points, they give us 1. But there's none of this other fee stuff, and it gives you the traction you need as an investor to really get out there and do a lot of deals. The limitations on these is, again, they don't go below 50K. So you're stuck. If you're in a market where you can get some sweetheart deals, you can't do those deals 50. That's where we come in JV. But they'll do these deals all the way up to, we've done them up to $500,000 where they'll fund those deals. So does that answer that?
Yeah. So like on each one, they're going to still have to bring the property to you for approval, right? Because like you said earlier, people think when they get a credit line, it's a blank check. It's a wild, wild west. They can go do whatever they want. But that's also where people get in trouble because it's dangerous for them, because it's like they don't want anybody over their shoulder telling them that the deal they have is not a deal. And then they go buy a house, and then all of a sudden they're stuck in that, and they have a bunch of money tied up that they borrowed off a credit line. So they have to come to you each property and submit each one, right?
Yes. So they underwrite the borrower first, and they give you, we issue that term sheet. That term sheet tells you how much capital you're getting approved for, what your interest rate, what your fee is. From there, going forward, you can go and bring as many deals as it takes to fill up that line. And the example we used on a buy-in for 80 and putting 20K at rehab, you could go do 10 of those, because that means you're putting 10% down to do those deals. But yes, to directly answer your question, every property has to be individually underwritten, whereas you as the borrower are already underwritten, and you're underwritten for 12 months. So they don't look at your credit. They don't look at your taxes. They don't look at your debt to income ratio. They don't look at any of that once they underwrite you. And by the way, these lines of credit aren't based on debt to income ratio at all. Anything that we do. And that's one of the reasons, like on when you asked about so if you're using the line of credit, for example, on buy and holds, well, what would happen is that if you went to the bank for a rental property, a buy and hold loan at a bank, the bank is going to look at your debt to income ratio. And after you do 4 or 5 of these, they're going to say, you don't have the debt to income ratio you need to debt service this property, right? All of our lenders, I should say it differently, none of our lenders require debt to income. And that's why this is amazing for your subscriber base to literally just build this enormous portfolio. The deal just has to make sense.
Okay. So do y'all look at past performance? So say someone came in and they got a $200,000 or $500,000, yet they don't have the cash in the bank, but they've done 10 deals with you over the past year and everything went smooth. It was great. They're performing. Do y'all take that into account to open up a bigger line for them? Is that something that y'all do?
So what they do, I mean, so to be clear, we are a direct lender on lines of credit. And what that simply means to your subscriber base is we have institutional money that comes in and table funds the deal in our name. So USA Private Money is the lender of record, but there is capital that's coming in from these institutional real estate funds that funds the deal. So when you say, do we look at this? We have underwriting guidelines that we have to go through. And essentially, I think to answer your question said a different way, what if you have 10 properties that have, collectively, 500,000 of equity in the properties? Will they look at that? And they absolutely will look at that because they see that you have net worth and you have assets and that you have experience. And so when they come up with what they offer you on this line of credit, they take all those kind of things into account, which I call it's make sense funding. If it makes sense and you look like you've got the experience, for example, if you've got a decent credit score, call it 680, let's say you got 100K, let's say you've done 10 deals, you're absolutely going to get approved for a $500 to $1 million line of credit, depending on, and we've got 2 or 3 sources that we're able to work with people on.
Okay. So I think the biggest fear for most new investors that come to me, or even experienced investors, is the income, right? So they either just started an LLC, or most of them are coming into real estate because they're not making good income in the first place, and they're scared that's going to hinder their chances to get a loan, or they're a little savvy as an investor and they may be making really, really good money, but on paper it looks like they're not doing much because of the way that they've structured everything on the backside. So how important is income, and how important is credit score? I know we talked about this a little bit earlier and you say you get around it, but just to kind of alleviate the fear for a lot of these individuals, because a lot of them shut off. They're like, well, I don't have income, I don't have credit, nobody's going to give me a loan. So they never even try. So let's talk about this a little bit more in detail so they can kind of, realize that there's options for them.
All right. So let me put everybody at rest. Lender does not care about your income. They don't. What they care about is, can you debt service the loan? Can you make the monthly payment on the loan? And so what they're looking for is, do you have 6 months in reserves? All right. And so if you want to get creative, the way you get creative is you have either a stock account, an IRA, a 401k, wherever, that you may have some money sitting. If you've got access to that, that becomes your reserves. And so that checks that box for the lender to say, yep, they got some money sitting over here, even though they may be a new investor, they got a new entity, LLC set up, they haven't made any money doing deals. What they're looking for is those reserves. And so if you don't have the reserves, a trick that you can do is all you do is find somebody that does have the reserves, add them to your entity, and then they will count that for you, and you guys are off to the races.
Yep. Okay. That's pretty good. Okay. Now what about, like, you're just talking about, so say you had 50 grand and you'll do 10x credit line. Or just say like 100 and you gave them $1 million credit line. Do they have to leave that $100,000 liquid in an account? Because we make money by investing our money. Most people are way over leveraged in the first place. So like, say you check up and 6 months later you say, we want validation again that your money's in an account. Do y'all check up on this? And what happens if they don't have any money in their account then? Because a lot of people can simply just, like you're saying, have someone else come and put money in their account for a little bit of time and then transfer it out. So I'm sure people play games all the time. Can y'all pull that line from people just like that if they don't have those funds later?
Right. All right. So this is not like when the Great Recession hit and everybody had these home equity lines of credit that they were using to do stuff, and the banks got scared. They went in and they pulled those lines with no notice, and they said, hey, you got $300K on your line, we're cutting you to 100, overnight. And you're like, what happened? And nothing happened. It's just they were hedging their position, right? They were making sure that nothing happened. Well, with these lines of credit, they're different. Remember, they underwrite you once in a 12-month period. So once it takes about 30 days to get you through that underwriting process. And once you go through the process and we deliver that term sheet to you, you pretty much set that as what it's going to be like for the next 12 months. At the end of 12 months, they review your line, and they'll typically they're increasing, occasionally they're decreasing if somebody just had a tough time and can't show that they're making money doing this business. They don't want to increase their line. But as a general rule, they're going to increase the line. And remember, they got money in a real estate fund that they want deployed. So they want this money out there working. Whereas the banks, they're totally different. And so don't confuse this with a home equity line of credit.
Yep. I appreciate you clearing that up, because a lot of people, there's so many options for them and so much misinformation. They don't even know what to believe or what's real or what's legitimate. So we went over and we covered a bunch of stuff. We only have an hour here. They have all sorts of different options. So say you're the investor bringing the deal. They can fund your rehabs. They can get you long-term buy and hold loans, credit lines. And they also have that really good option for you to JV under 50K price points, which a lot of you in the center part of the country, that's right where you need to be. Also on the other side, they've got their Private Money 360. If you're a lender needing to get money to play, guys, reach out to them. So you want to go ahead and give them all your best contact information right now. You got your website, usaprivatemoney.com, but is there other ways or emails or phone numbers you want to give out for them to reach you directly?
Well, so what I'm going to say is we build a business here, and I'm going to call myself the weakest link in the business. I've replaced myself with some amazing talent that are there to help. And so our main phone number is 480-372-8081. And when you call that line, I'll give it to you again in a second. You call that line simultaneously rings to 6 private money consultants that are standing by, waiting and ready. Very knowledgeable, seasoned, experienced private money consultants. So if you call that line, 480-372-8081, one of those private money consultants will pick up your call. I'd say very rarely does a call make it to voicemail with us. And if it does, it's called back quickly. The second thing you can do is on our webpage. There's 2 or 3 different options there that you can go in and submit a funding request to us. And same thing, that is a lead form that goes into our CRM, and it's sent out in a round robin fashion to our 6 private money consultants. And I'm alerted every time one of those leads come in. And I can assure you that I see that, and I reach back to these people and say, hey, you see that lead that came in, call them. And so it's really, really important to us that you guys are getting the service that that you're looking for. So that's the best way to reach us. And then on the private money 360, you'll notice that on our we didn't cover this as a topic, but on our main webpage, there's a box there that says flip your capital. And if someone were to click that box and says that they want to be the bank and wanted to flip their capital instead of maybe flipping a house, that's how they access the Private Money 360, or they can go to Private Money 360 directly.
Yeah, which is a great way to make money because, guys, like we were talking about earlier before we got on here, the lender's the best seat in the house. If you can get to that position where you're lending money, you kind of hit the top right there. That's the best position to be. It's the most passive because even rentals, I mean, or even notes, really. I mean, I just took one back last week, and man, you should see what they did to this house, right? So it's not 100% passive, but it's close to passive. But I also want to point out one more time, guys, if you didn't catch earlier, they do this nationally, right? All the markets. Is there anywhere that y'all aren't willing to do a loan?
No. So you bring up something really interesting. Some states require a specific license that we may not have, but as a consultant, we can still work with the people and help them. It's just we don't collect the commission on the back end when the deal funds out. But as a consultant, we can absolutely guide them, direct them, and help them. And so don't let that concern you if you're in an area that may require a specific license for us. Our consulting agreement protects them and protects us, and it enables us to consult with them and get it on place with the right lender that'll fund the deal.
Okay, very good. So we got a few minutes left. Is there anything that, I mean, we touched on a lot. Is there anything that we didn't cover that you think is important, or did we pretty much get it all?
I would say to you, you've been super, super thorough in this interview. Rarely do interviews I do go. And I can tell you're a seasoned investor, Connor. You know the right questions to ask. And the main thing I would just say to people is that, get past, it's usually the 6 inches between your ears that causes you to hold back. And you got to overcome that fear that you're having and take some action. And just know that here's the really, really cool thing. If I would say that there's a secret or a nugget, is we offer really coaching for funding and deals, through our private money consultants, meaning we don't market that as a fee thing that we charge anybody. But I'm telling you, we know this business as well as anybody. And when you call one of our consultants, they're there to just help you analyze your deal, help you, look at these 26 different things that maybe you haven't thought of. And so when you find a deal, by all means, call us. I mean, you don't even have to have a deal. Call us and say, guys, help me understand how this process works. And they'll take you through the calculator. They'll help you analyze, a mock deal, and just help you, get the confidence you need that the money's there to help you do the deals.
Yeah. So I think it's really great what y'all are doing. I'm impressed with it, with all these options for all these investors out there, helping them kind of build their business. I just want to say thanks. I'm grateful for you coming on today. And guys, reach out to them if you want to find out more about what they do. It's usaprivatemoney.com. And guys, we'll see you on the next episode.
Awesome. Thanks, Connor.
All right. Thanks, Scott. Appreciate it.